I wanted to talk about some math. I thought it'd be fun. This is math that is very specific to options traders. You absolutely don't need to know how to know what this is or how to use it necessarily. But if you are an options trader and you're interested in back of the envelope calculations, I think this is the one that I'm going to talk about is going to be really interesting. Okay, so the Black-Scholes formula is gross. It's pretty gross. The whole Black-Scholes model is extremely helpful for options trading. It really revolutionized the options market because before this model existed, there was really no quantitative way to determine the fair price for an option. So this was a revolutionary change to the financial sector and really gave birth to the options industry as we sort of know it today. So today I wanted to talk about a cool approximation that people can use to find the fair value of a call option using some of the parameters from the Black-Scholes model. I wanted to talk about the derivation because I think it's kind of cool, but you definitely don't need to understand this to be able to use the result of this math or to be able to trade practically. But to sort of start out, this is our nice Black-Scholes consequence. If we assume a risk-free rate of R, a fair price of a call option C, with time to maturity T on a stock price with spot and a stock with spot price S and volatility sigma, you can find that by plugging in these values into the Black-Scholes equation or the Black-Scholes formula. So we're with N just being the cumulative distribution function or the normal distribution, your S, your strike price K, your risk-free rate. And plugging all these various things into this very messy form, you can find the fair price of a call option. Most people just use a calculator to do this, or they'll use a computer to do this. But there is actually a way to simplify this form so you can estimate it in a pretty back of the envelope way. If you ever model, for instance, options prices, this is a lot of the time the base that you'll use for it. But we can agree that it's gross, right?
Yeah, definitely 100%.
It's pretty gross. So I wanted to talk about the methods that you can actually use to simplify this down, which is pretty cool. And it does use some pretty complex math, which is why I'm saying that you don't really have to understand where the result comes from to be able to use it. But some of y'all might find it cool. So we're starting with this price for the fair call option. And we can start by making some assumptions to sort of reduce this down a little bit. So the first one that we're going to do, this first simplifying assumption, is that we're going to be specifically looking at the at-the-money call where the strike price is equal to the spot price of the underlying. And if we assume a small risk-free rate, then we can take this other expression, this expression for the fair price of the call, and we can plug some of these variables in to actually simplify it a little bit. When we assume this at-the-money call price and we assume a small risk-free rate, it actually eliminates a lot of the terms that went into this D1 and D2, the terms that went into the CDF of the normal distribution function, right? So from that, we can get an expression that's already pretty refined. Specifically this lower expression, which is just from those simplifications where that basically comes from. Does that make sense? What's going on here? We're really just we're assuming that some terms are small, which is a fairly good assumption to make. We're looking at one type of option specifically. And then from this equation, this one in the box, we can reduce it down to this sort of lower form, which is already a lot simpler. But still, we can do a little bit better. So to now simplify this down a little bit more, we can use something called a Taylor approximation. In numerical methods comes out so much. This is an extremely powerful way to sort of do numerical approximations, where we basically say that our value, whatever value that it is, can be approximated. So for the CDF of our normal distribution, we can basically approximate this into a number of ordered terms that are the derivative of the function itself. And effectively what we're doing is we're saying okay, so I can basically sum up a bunch of different terms to approximate in a series to approximate this value, which is a little bit more complex. And I can say that the first two values specifically represent sort of most of the value in this approximation. And what that can do is actually very significantly simplify the form that I'm ultimately working with. So if we do this Taylor approximation, which is a really cool methodology, if you guys ever get into numerical methods, you should totally look into Taylor approximations. They're really, really, really important. But from this Taylor approximation, if I take the properties of the the CDF, the cumulative distribution function of the normal distribution, then we can reduce these normal terms, these CDF terms, into something that's a little bit easier to simplify within the context of the rest of this approximation. It already looks cleaner. See, this normal, right? We started out with this where it's ND1 and ND2 in our Black-Scholes, Black-Scholes formula, right? As ND1 and ND2 where D1 is the logarithm, all this stuff, right? There's a whole lot of terms, a whole lot of stuff going on. And from a couple approximations, specifically by looking at the money call, by assuming that the risk-free rate is small, and by assuming that this term, this sigma root T term is small, we can apply the Taylor approximation to reduce pretty much all of this into something that's a lot more comprehensible. More specifically, if we take the 1/2 sigma root T and do that Taylor approximation that we were talking about on the previous slide, you can now estimate the fair value of an at-the-money call option for a certain spot price, for a certain volatility, and for a certain duration using this formula, which is way simpler than what we were looking at before. Put the derivation in here because some people might find it useful, and I honestly didn't want to spend a whole lot of time on it. Was a real long shot that anybody would have actually seen this derivation before or heard of it. It's actually I'm not going to pronounce this right, but it's a specific type of approximation that we were talking about yesterday on the show. I included the derivation in here in case anybody does want to work through it. I didn't spend a whole lot of time explaining it because I honestly don't think that most people need to know it. If you want to go look through it, you can, but the results of all of that stuff, I think, is incredibly interesting. Specifically, that the fair price of the at-the-money call is approximately equal to 0.4 times the spot price of the underlying times the volatility times the square root of time. And specifically, what you can use this for is if you're ever trying to do back-of-the-envelope estimations for the Black-Scholes model, and you don't want to use this not garbage, it's extremely useful, but this mess of variables and equations, you can use something kind of like this. So for example, if you're looking at a 45 DTE at the money call for a stock trading at $100 with a volatility of 20%, it's just really a back of the envelope calculation. It does have a square root in it, which is not ideal, but it is a back of the envelope calculation that can give you an estimate for what that fair value is. And then if you, for instance, go look at a Black-Scholes options pricing calculator. So here I used the one from Wolfram Alpha. This is also a great resource if anybody ever wants to do like back of the envelope Black-Scholes calculations, or you're trying to do Black-Scholes estimations. They have one on there on Wolfram Alpha. But when you actually plug this into a Black-Scholes options pricing model, the gross one, you get a value that's really consistent with this approximation. So you don't need to know, like I said, the derivation or how we got there. If you find the derivation interesting and you want to work through it and you have some experience working with this type of math, I think it's a really cool sort of exercise. But this result, I think, can be really helpful, specifically because your alternative, if you're trying to do any kind of like options pricing simulations or any kind of options pricing estimations, is something like this, which is not very practical. The result, like that approximation specifically, I think is immensely helpful for people who are trading options. You don't need to know the derivation to be able to use it. Does that make sense?
Yes.
Thank you guys for sitting through my math. I kind of had a fun time writing this stuff out because I haven't used LaTeX in a while. So it's kind of fun for me, but hopefully you guys found it interesting and hopefully you guys found the results kind of useful.